Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TjStearns Incorporated. Trust, respect, and results. TjStearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder of TjStearns Inc. and your resource, Chicagoland, for proactive guidance and insight and a common sense approach to planning, helping to uncomplicate the financial world. Tim, no easy task, but that is a big part of what we are going to be striving for today in helping to review and evaluate the pros and cons and what the listeners need to know about the various investment options that they have.
Well, I think it's a good time to do that because, with interest rates going up, a lot of these products were kind of forgotten for the past couple of years, literally. So we're looking at other things besides the market, which the market has been choppy over the past year or so as well. So just to give people some more education on different options that are out there.
Well, ladies and gentlemen, if you have questions, if you would like further information or education about any of the investment options that you have available, and maybe most importantly, how to bring them together into a cohesive, comprehensive plan for your retirement, pick up the phone and give certified financial planning professional Tim Stearns, CFP, and TjStearns Inc. a call, 800-640-2256. That's 800-640-2256. 800-640-2256. And Tim, putting last thing first, we are going to talk about the various tax status under which we can put each one of these investments a little bit later in the program, which may be the most important part of determining what investment options to utilize and what we are aiming to accomplish with each and every bucket. But kind of going back to the very first thing is that there are many different investment options out there, and each one of them kind of serves a unique purpose and has different pros and cons and benefits and disadvantages. And in order to make informed decisions about where to put our money, we've got to really understand what those different qualities of each location represent.
Right. So, let's start with the banks. Pretty self-explanatory, right? Most people have a checking account. That's the thing that you're going to be using the vehicle that you'll be using to pay your bills, your paycheck gets deposited in there, managing daily cash flow and that type of thing. Then we have savings accounts, right? And so savings account is maybe what's left over after that. And then what I'm finding a lot of is people are, they're scared of the market a little bit because of what happened last year, and they're sitting on a lot of savings. So one of the things we'll do for people is we'll run a inflation report. And it literally tells them, hey, inflation's up above 6%. The Fed has already said that it'll probably be up over 4% through 2024. And what are you earning on your money? And we can show them the contrast of having too much cash on hand. And actually, it's almost like a lazy money exercise, right? To show people that, hey, your savings account is not keeping up with inflation. So you're actually losing money per year, and it breaks it down 1, 5, and even 10 years. That is a great report to just kind of crystallize what people are missing out on. And I think that's a great way to take a look at that.
Tim, do you find that a lot of people, despite the inflation, despite the rise in interest rates, still have a lot of cash or cash equivalents that are not keeping up, that have not improved on that interest rate?
It's funny you bring that up. Yesterday, I met with a couple that had over $600,000 in their savings, and I showed them, and the one example, based on what they were earning on their account, they were missing out on $5,000 a year, and then extrapolate that 5 years, it's well over $25,000, just the power of compounding, right? So that kind of got them to move the needle. The rule of thumb is that if you're both working, to have maybe 3 months of your bills in a vehicle in case someone loses their job or something, then that might jump to 6 months. But these people, their house was paid off. They had lots of IRAs, 401ks, that type of thing. They literally were just didn't know what to do with the money. And, I pointed out to them by doing that exercise and show them that report that, hey, you need to get your money doing something. Why is it being lazy when you've worked really hard your whole life? And that got them to move the needle to do something.
Well, Tim, if we do not, and we allow excess cash and cash flow deposits to build up in checking or savings accounts or other low interest kind of bank style accounts, there's a time and a place for that. There's a necessary component, as you talked about, regular expenses, the emergency account, but there's an upper limit to what is suggested for that emergency account, because essentially we are losing money safely there. And that's why we need to explore some of these other options, correct?
Right. I mean, losing money safely it goes against everything I learned in undergrad or in my master's, but it's well said. You are losing money safely. We had a woman in here the other day who had over $300,000, and she's just living on that to do whatever she wants to do, and she could not get it out of her head that, if she puts it in a vehicle with us, that she still has access to it, and the bank, I called it her pat money, right? You pat it, like a dog, and I said, if you pat the money, you can pat it over in an account that we have, where I have my 93-year-old mother invested in that has a track record since 1988. I think that that's not a bad place to be. And she laughed and she said, okay, I get it. And that moved her to do something.
It's there. It's comforting. It's keeping you company.
Right.
You can pat it.
Right.
I get it.
Right.
And I think that is why people do appreciate banks, is the safety and the liquidity factor. They can get their hands on it if they want to, but where you're getting those qualities with your dollars, Tim, you've talked about money's pretty terrible at multitasking. And so you're not getting the growth that's necessary.
Right. And that goes along with even like a certificate of deposit. Or I've had a couple of clients who are humorous and said certificate of depreciation or certificate of disappointment. And that being said, there's other things out there like multi-year guaranteed annuities are a great vehicle to put money in that is guaranteed by an insurance company. You're not locking it up for 20 years or anything crazy. But that, like, we have people who are coming in here a lot from our retirement classes that are kind of buttoning down what they're going to do the next step, but it's about 3 to maybe 5 years out. So they might want to use some of that non-qualified money to buy another place, whether it's warmer or even Wisconsin, to do the summertime thing up there. A multi-year guaranteed annuity would be an excellent vehicle that, could tie it up for maybe 3 years, get some interest on it. That's very safe. At the end of 3 years, they're free and clear to do whatever they want with it. But that's another vehicle that we're using for people.
Yeah, and we're going to be talking specifically about annuities, why we hear so much about them, either the pros or the cons, and where to weigh those. But Tim, there are many options that you have available in the investment world. And moving on from the bank world to that investment world, it ranges the spectrum here from conservative to more moderate or even aggressive or speculative. And there are a lot of options in between there. So can you talk to us about what we normally hear about bonds and stocks and where those fall into our choices and options?
Well, a little bit of a history lesson, right? In 1994, when I got into the industry, if you came to me, I was just a stockbroker, I wasn't a financial planner, and you said, Tim, you know what? I want to do something really safe. I would tell you that we would put it in bonds. If you said, Tim, I want this money. If I lose it, I won't be happy, but it won't kill me. I'd like to go in some stocks. That would be the other side of that coin, right? Well, nowadays, stocks and bonds lose, and they're correlated. We've seen that a million times. Last year, bonds lost 13%, while the S&P 500 lost 18%. So that wasn't always the case. So now we're seeing the Fed raising bond interest rates, right? Raising the Fed rate. What that does is it works inversely with the price and the value of your bond. So when new bonds are coming out at a higher price, it's inversely related to our bonds. So we need to be very careful about that. Now, the other gamut is looking at stocks. You might want to be very cautious for this year. I think it's going to be choppy. But, that's where active money management comes into play. So even our bond portfolio has stop losses on it. Is it perfect? Absolutely not. But it does have stop losses so that people don't lose money in that as much as if they were in a bond index fund. The same goes for our stocks. That too has a daily stop loss. So we're making sure that we, if something terrible is happening out in the world and we need to get out, we're trying to do that. We're not going to be perfect. There is loss, but not as great as if you were in an index with a mutual fund or something like that.
Tim, stocks, bonds, mutual funds, exchange traded funds, bond funds, all of these things I think are commonplace. And most people are probably at least on a surface level of aware. But the stop losses that you are talking about and that you can help include in your clients' portfolios are not something that I think a lot of people may be as aware of. Can you talk about where those play an important role in the progress of your clients there at TJ Stearns Inc.?
Sure. So I'll give you an example. We had a guy in here the other day who had just turned 59 and a half, and he was asking about the 59 and a half in-service distribution. So how does that play into there? Well, he could take the money out of his 401k and put it into a vehicle with us that would literally have more active money management and stop losses. Again, there could be loss to principal, but I would think we would do much better than any index that's out there. And we did last year. The year previous, we outdid it as far as what we made on the portfolio, being up above what the S&P 500 had done that last year, the 2021 as well. So the way it plays is our liquid money is we tell people, if you're going to have a growth bucket, this is where we're going to put money. If we're going to do safe money, we're going to make sure that you put it in a, something like maybe an annuity, maybe you put it into some cash, or a multi-year guaranteed annuity. But I'm just saying anything that is going to be at risk with us, we're going to do it institutionally and have stop losses.
So again, ladies and gentlemen, many options available to you in your financial progress. You need to understand their qualities, the appropriate location and purpose of each of the investment options, the pros, the cons, benefits, disadvantages, what you can expect to get out of them. And if you need help in weighing those options, you can turn to the help of a certified financial planning professional. Tim Stearns, CFP, is Chicagoland's resource for that common sense approach. You are welcome to give a call. He does offer, if you have saved at least $500,000 for your financial future, the opportunity for a complimentary, detailed forensic financial analysis, investment, and portfolio review, and then strategy session, designing the Protect and Grow plan. They're available at TJ Stearns Inc. And all you need to do to take advantage is give a call. No cost, no obligation. 800-640-2256. That's 800-640-2256. 800-640-2256, the number to call to take advantage of that. And Tim, I think that people are loosely aware of the modern portfolio theory where over time we sort of shift from a more aggressive portfolio, maybe more in stocks, to one that is a little bit more conservative in bonds and bond funds, something that theoretically wouldn't be as volatile. But can you talk about that evolution maybe over the last 20 or so years and what we have come to find out after sort of stress testing that philosophy?
Well, the last 22 years in the stock market has definitely stress tested it, right? You had 2000 through 2002, the market lost 50%. Another time, 2007 through 2000 and early 2009, lost another 50%. So what came out was a lot of funds called target date funds or retirement funds. And you basically, put in, I'm going to retire in 2030. So I'm going to put all of my money in there. Into that fund that XYZ company has. Well, and the idea there is that as you migrate in your career to 2030, you're going to have less and less risk. The only bad thing I will say about that is that it's not a silver bullet. It's not going to stop you from losing just because you're in a 2030 fund and it's 2029, the market dips, you're going to dip too. And that's why I plead and beg and tell anyone that will listen to me, if you are over 59 and a half, go talk to your 401k provider. You don't need to talk to HR. This is between you and your 401k. The analogy I use, it's almost like a HIPAA, Health Insurance Privacy Act. You can go talk to your HR, but it's going to stay between you and them. But ask them, am I able to be in charge of my future by moving my money into an IRA that I can self-direct, or I can have an advisor help me, because I don't feel like your mutual fund lineup is going to really cut it when the market takes a hit.
So again, we've got to know about these options. We've got to know about kind of the modern evolution in that modern portfolio theory, or the old asset allocation model, the split 60-40, 50-50, 30-70 of stocks and equities versus bonds or fixed income. And we also need to understand some of the alternatives that are available that can work to help us achieve the fundamental goals that those old premises were set up around. And if you'd like to see how stop losses work inside of your portfolio, or get that protect and grow plan individually and specifically designed for you, it's at no cost and no obligation with certified financial planning professional Tim Stearns, CFP at TjStearns Inc. If you have saved at least $500,000 for yourself in investments and retirement accounts, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So Tim, you have mentioned annuities on a couple occasions throughout the course of this program. Can you break down annuities? Because it seems as though they are hyped as either the solve-all solution, the best thing in the investment world since sliced bread or the invention of the stock market, or they are talked about as never to be considered. Why is there so much debate over annuities?
Peter, you see a lot of people, poo-pooing and saying that the annuities are the worst thing in the world. And then you have people who tout them to be the best things in the world. I think a lot of the consumers out there aren't exactly educated. Do we cover them in our retirement classes? Of course. There's a lot of great studies from Ibbotson, other industries that have done tests on that to show if you have an annuity in there, it would really prop up a portfolio in retirement and take the heavy lifting off of the portfolio to return X amount. We just read an article the other day where, the safe withdrawal rate is down to 1.9%, according to a study done at the University of Arizona. So, what is the safe withdrawal rate? Well, you don't need to worry about that if you have an income allocation plan and you partner with an annuity. Now, not all annuities are good and not all annuities are bad. But when we're doing income allocation plans, we're using only A+ rated companies that have been in business. One of them is over 200 years, but basically showing the person the ability that we'll have to actually make sure that they don't outlive their income. That's why I like annuities, the lifetime income. The other thing I like is that it's based on my wife and I. If something happens to me, she will still receive the same payment. We have a lot of first responders as clients, and a majority of them will only get half the spouse will if, God forbid, something happened to them. So a lot of times they'll like that as well. And then the other place that I see that for is if someone has a pension and they have a lump sum, that is a great vehicle to put the money in there, because with a pension, if something happened to the spouse, usually you're either going to get nothing or you'll get half. Depending on what your choices were. So why not take control of your retirement? All that money that you've put in over the years is a great spot to make sure that your family gets the money back.
And I think that ultimately, Tim, we've got a few long-term goals with money. We want growth. We want income. We want to preserve it and protect it where possible. And we want to pass it on as a legacy if we don't use it for income, right? And again, talking today about the various investment opportunities and options that we have, we may get more specific with a particular dollar, and we really need to weigh which one of all of these options best helps to work to achieve that.
Right. I think an annuity does a lot of different things. It's not for everybody, but it is something that I know is a guarantee from the insurance company. The money's insured. I don't know of any other product that does that. If one comes out, I won't use annuities anymore, but I don't know anything else that does that.
Well, again, if you would like to weigh your investment options, get a detailed, thorough overview, forensic financial analysis, or portfolio design. If you'd like to better understand the risks that you're taking, the fees that you're paying, how each of your accounts is positioned, what investment options you are currently utilizing, and if there could be alternatives that would work better to help you achieve your goals. If you'd like to see how stop losses within your portfolio could potentially benefit you. If you'd like to look at how to be more efficient with taxes or when and how to claim and collect Social Security. If you have saved at least $500,000 for yourself in investment and retirement accounts, no cost, no obligation for the complimentary review and strategy session. All you need to do is pick up the phone and give TJ Stearns Inc. and Tim Stearns CFP a call now. 800-640-2256. That's 800-640-2256. Now, Tim, we've heard the saying, it's not what you make, it's what you keep. And in retirement, it's not what you have, it's what you get to keep out of those accounts as well. Can you talk to us a little bit about the different and various tax statuses and the placement of our dollars and why this is maybe the most important consideration for us?
Well, I'll give you an example of one of the things that annuities get a bad rap for, and that is, if I put my money in there, I A, lose control over it, and B, I'll never be able to access the money. Because what if I want to take out a huge chunk of that IRA to go buy X, Y, and Z? Well, if you do that out of qualified money like an IRA, you're going to have a huge tax hit, right? So that's another reason that I enjoy annuities, because it just starts to, it's a lifetime income, but I'm living off of that every month. I'm not taking out huge chunks of that. So that is a great spot for, in my opinion, IRAs that I'll have to take out, whether required minimum distribution is 73 years old this year, or when it finally gets to age 75, that's a great spot for an IRA. Now, for non-qualified accounts, that is not a great spot for it, depending on what your situation is. So what with us, non-qualified, meaning, just a joint account you might have with your spouse, or, we see a lot of people who have a stock account that they pick some stocks here and there. That's a great spot to put into a growth bucket, right? It's all liquid, but it's not all taxable when you pull it out, only the capital gains. And hopefully they're long-term capital gains, which put, lower than your income tax bracket. So those are the vehicles that we look at, maybe an annuity to throw off income besides your Social Security that's guaranteed for your life and your spouse, or then looking at a growth bucket that has stop losses, that the money's liquid at all times.
Again, we are talking with Tim Stearns, CFP, Certified Financial Planning Professional. If you've got questions or concerns about the investment options that you are currently utilizing, and if your dollars are placed in the right and appropriate type of strategies and types of placement and investment options that you do have available. If you'd like to review your current 401k options, your IRAs, your Roth IRAs, your non-qualified investment and brokerage accounts, those retirement accounts, and set them up to make sure that they are properly positioned to help you not only weather downturns in the market, but also to benefit when there are advantageous and opportunistic market environments. Pick up the phone, give a call for that complimentary review and strategy session. If you have at least $500,000 saved in your investment and retirement account portfolios, this is no cost, no obligation opportunity for you to get that plan put together. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, a very high level discussion today about the various investment options that we have. Didn't even get to several that I know that you talk and hear a lot about and discuss with your clients, but there are plenty more out there, just the kind of main ones that we're hearing about and a few that are widely debated.
Right. And we just touched on some of them. I will tell you though, if anyone wants to come to our class or they can Zoom it, give us a call. We go over everything in depth. It's only a couple classes, but it gives a lot of information that people can ask and have give and take with us to explain exactly what each of these vehicles can do for you. Today is just, to me, an appetizer. The entree is in our class, or if they come to see us.
Again, if you'd like to attend one of those classes or get the individual plan, the Protect and Grow proprietary plan from TJ Stearns Inc. and Tim Stearns CFP, pick up the phone now. Give a call, 800-640-2256. That's 800-640-2256. Tim, always a pleasure.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit TjStearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.